As we've been talking about, Amazon plunging in today's session, right now down about 10%. The company slammed after reporting revenue and sales misses in its closely watched Amazon Web Services, alongside disappointing guidance for the holiday quarter. For a breakdown, let's bring in John Blackledge, Cowen Managing Director. John, good to see you here. What do you think is more problematic here? Is it the slowing growth at AWS, or is it the slowing growth at the retail operation?
Yeah, I mean, I think let's unpack it here. The 3Q revenue was fine. The op income missed, and the 4Q revenue and op income was light. What did management say? Management said that various macro headwinds are impacting the consumer and consumer demand more so in Europe than in the U.S. And then also headwinds are impacting companies who are looking to control cost. And you're seeing that show up at AWS and also at the ad business. So on the guide, the revenue guide was 7% below consensus at the midpoint. And then the operating income guide of $0 to $4 billion was below consensus at $5 billion. And also investors were looking to have a 5 handle on that guide, and they didn't get it. So all in, we cut 4Q numbers, we cut longer term numbers. Our 23 revenue is 7% lower, EBITDA 12% lower, price target to 150 from 195. We kept outperform even kind of amidst more muted growth next year, just given we should still see margin expansion and investment spend should decline.
We're watching Amazon stock tanking here on the day. When we think about some of the high growth internet names that the markets have based their bullish run over for the past several years on, and only to see that kind of decline over the past almost year in aggregate now at this point, using November as that peak point. With all of that in mind, what is the normalization for those high growth internet names now, reemerging from the Fed's tightening policy, from the consumer sentiment right now and spending habits?
Yeah, no, it's fair. I mean, if it was quite a week, right? And just to try to sum up Amazon versus Alphabet versus Meta, starting with Amazon, it was really macro related, inflation, interest rates, energy costs, Ukraine war, impacting the consumer, as I mentioned, impacting company spend, and which is seeping into their retail business, AWS, and advertising. And you saw that partially hit in 3Q, and then it was implicit in their 4Q guide. And then they're also dealing with kind of lingering spend issues, but they're working on it. They called out fulfillment spend, CapEx spend down $10 billion this year, which is so they're working on it. For Alphabet, it's also mostly macro related. You do have competition from TikTok at YouTube that they're dealing with. And the other thing I would say is that they had, accelerating headcount growth that now they're switching on a dime and they're going to start to slow it down, but it's going to take a minute. And then Meta is different, I think, than Alphabet and Amazon in the sense that it's macro. It's TikTok more squarely at core Facebook and at Instagram. And then it's self-inflicted wounds of spending at historic levels going into next year, which is kind of opposite of what Amazon and Alphabet are doing. And it feels a little tone deaf just given the macro issues. So that's why we moved to the sidelines on Meta after they reported and gave guide. But no, it's clearly been challenging, but we still like Amazon and Alphabet, great companies, and they are dialing in spend, which makes sense given the kind of current environment.
John, which teams, management teams, are the ones you just mentioned, Meta, Alphabet, and Amazon here? Which management team is not tone deaf when it comes to expenses here?
Well, I think Alphabet and Amazon. Alphabet is slowing hiring spend, and you're going to start to see OpEx growth start to slow, which makes sense with their ad business that kind of missed across the board in 3Q, with weakness in like financial services, which we never heard them call out before. And then Amazon, same, littered in that call last night, and in the callback was kind of working through cost containment efforts. But for these companies, they're like battleships. You can't just turn it on a dime. So if you take steps to relieve or have cost growth decelerate, there's some lag there. So it's going to take several quarters for it to play out. But you are, like at Amazon, you are seeing it. Like they had historic spend and fulfillment, CapEx the last couple of years with the pandemic. that's declining significantly. And there are some efficiencies that you're seeing, but again, it's taking a little bit longer than everyone would like.
John, if I'm not mistaken, you still have an outperform rating on Amazon, which one can tell from hearing your commentary here. Do you still have the $150 price target? And do you think that today's the bottom, or that we're in a short-term bottom, or do you think there could be more downside before we see some buying come back in?
Yeah, I mean, I think obviously, and it was down, kind of the last couple days with Alphabet and Meta, kind of missing as well. Yeah, I mean, it's trading at like 10 times EBITDA, 3% free cash flow yield. The valuation is fairly appealing for a company with market leadership and global market leadership in several big verticals. I think the selling it could be a near-term kind of low, and then I think investors are going to have to see where sell-side numbers shook out, where their numbers shook out, and see how confident they are, kind of stepping in here.
John, good to catch up with you. John Blackledge, Cowen Managing Director. Appreciate it.